Hello, welcome to JS Services Strategy Recap. Today we're going to take a look at a bear trend correction with the R level equal to the upside pivot. We're going to look at the S&P to start. Bear trend correction, the market's produced a positive signal against a negative trend. So the market's been trending lower and we've had a positive signal against that trend. The market's still vulnerable to the downside, but does have the potential to produce a counter-trend corrective rise. The market is searching for resistance and can be characterized by a stop-and-go trade with sharp positive reactions. So we have this expectation that we could see these sharp positive surges and some stop-and-go trading as well. The positive corrective action can disappear quickly, so avoid leveraging up on any rally as the negative momentum will try to reestablish itself. This is a money state, and good trade actions expected. So the market's either going to continue to tighten the collar on weak shorts, or that corrective trade's going to exhaust, which may be the start of the next bear trend leg down. It's important to always remember that you're in a corrective trade, so things can get squirrely, they can get emotional, there can be head fakes, but the underlying foundation is still bear trend, and so we want to watch to see, is that bear trend ready to resume? We'll see that in the structure of the market. Structurally, we have the R level above the market at the upside pivot. So this is going to give us a negative bias, negative sentiment bias. When the R level is equal to the upside pivot, it defines the expected exhaustion point for the positive push. You have a hard line that says this is the high point of the bear trend. The bear trend is true below this point, and if we violate this level, which is 2053.75 in the S&P, that's a signal that the market might be in transition to a bigger corrective move, maybe a positive shift into neutral, but the bear trend will be over. So this is a very dynamic level. It's hard, and it's defined at the upside pivot R level. All these commentaries are about giving you tells and insights to the condition. And if this bear trend is going to resume, the market will struggle to maintain a trade above this R level. That's key. Do we see the market struggling? Is it starting to falter? That's the tell, and we're going to look for reversal signals. We're going to look for that market to squeeze us a little bit. When it's playing around this level, we're going to look for that emotion, and it's like, prove it to me. And when we look through through that lens of expectation of a corrective turn, these emotional surges look weak. They look like false hope. They're not squeezing us, having us think, oh, the market's turning, because we're anticipating it. If we are able to build a base above here, we'll see that as well. But it's more likely a shift into neutral. Any move above the R level is going to be corrective, so we would expect difficult trading conditions, potentially some vacuum swings. But a false breakout or a reversal is potentially the top of the next move to new move lows. So if we do get that reversal signal, we may have just sold the high point of the next reaction lower. And it's something to just, if we do get involved in this and the market starts to behave like a bear trend, we want to ride it, and with the expectation that the corrective trade's over and the bear trend's going to resume, and just work negative structure. So taking a look at the S&P performance, here we have 12 midnight. Market's opening around the directional. We don't have any strategies around the directional. We're looking for an emotional surge to fade into, or we look for an exhaustive spike. So after the European Open, we get the emotional surge. Nice, classic. This is expectation, sharp, positive corrective moves. Pushing in, I've got the variance and the alert distance on here. So here's our variance. That's our optimal entry area, and then here's our alert distance. So we're always watching price action within market structure. So these are the major market structure points. And we have an initial surge into the level. We get a slight rejection. We get another surge that breaches the variance. So we come above the variance. So when we're looking at reversal strategies, we can use either the variance or the alert distance. But bottom line, we want to see that emotional surge. So this is kind of a classic reversal. It's a little more aggressive because it's just price qualifying above the variance. But you can use both. and you should use both. And you should be aware in a situation like this, you'd want to be more aggressive. Why? Because you're in a bear trend correction. This is a choice, one of the best opportunities for a sell UP reversal. You really want to get into this trade. You're looking really for an excuse, so you want to be a little more aggressive on your alerts versus a market that is not at such aggressive state. You definitely want it to price qualify through the alert distance. And here they give you a reversal, confirm it, immediately follow through, and we get a stabilization off the directional. And this should be expected. We're in a corrective trade. This is corrective action. This is messy. It's sticking and moving. It may be the top, but sometimes it takes a while before it's just going to go. And so they give you another surge back into it. And it's just classic. It's right out of a textbook here. And giving you a re-entry at the figure, coming back into that variance area, allowing you to participate. And then the market starts to break down, and we go back to the peak, and we're just looking at these major inflections, looking at price action, getting a confirmation failure here, and this is a fresh sell signal here. And they let you get back in, and they give you a full APMD down to the DP, back down to the DP variance. So anytime you're in a trade, you want to use these metrics as well to understand that as soon as you're entering that area, that may be it. And definitely you're entering the variance area, so you don't want to get too close to your figure. And when you're exiting, another thing is to use a real aggressive trail stop, and as the market enters into these areas, you can follow it real aggressively, and when it should stay below that metric, and it should stay pressed, and if it doesn't, you can get a kind of a stair step back up to the next major price map level. So it's watching price action within market structure. So the Dow is also in the same market state, same structure, same strategies. This is strategy-based trading. Take a look at the Dow. Here you have 12 midnight, same situation. Not a lot of interest. Emotional spike in Europe, and we have that first surge right into our variance. And then we have the emotional spike. So this price qualifies through the alert distance, and then price qualifies below it to confirm a reversal. I'm going to throw the minor levels on here because this happens a lot, where the market will surge into the CRX Plus, and the CRX Plus is a big level for us for the critical range. The critical range is defined by the upside pivot and the downside pivot. We have the directional in the middle, and then we have our 4 other key critical range qualifiers: critical range extreme positive and negative, and then we have our interior critical range positive and critical range negative. And this extreme can act as the kind of the squeeze high of a false upside pivot breakout. And so that's something to look for. If you're getting a breakout, we're in a bear trend correction. We have the R level here. A lot of times this CRX Plus level, you can anticipate that to be kind of the squeeze high, and you can jump on something a little earlier than anticipated. You can, when the market's here and it starts to stall out, you have to think we're in a bear trend correction, and we may be in this spike. Definitely, if you have the order book to look at what's happening here, but it can give you a lead into this reversal trade. It's not confirmed until it's here, and then it got messy, but it held the variances, it held the alert distance, and then the market starts to break down, trade below the directional, and we anticipate this market to work negative price structure. The DAX is another market, same market state, same market structure. Early break into the top part of the alert distance off the downside pivot, then we have the emotional surge into the upside pivot R level for a fade rejection, back down to we have a half APMD opportunity. They pay out a half APMD. Now all of a sudden they come back up, and they're giving us the reversal confirmation through the alert distance for alert 2, and then we come through and we confirm the reversal here, pay out half APMD, bounce back up to the figure. Very difficult trading in the DAX. This is slow topping action, but you had the big emotion here. And once all this action's done, sometimes that can fall through and you can get the big emotion to the downside, but they kind of overdo it then. This market didn't have a chance. We'll see what happens in the next session, but price qualifying below this metric would be important. because we're always looking at price action within market structure. You break market structure here. Here's first failure of market structure. This would be the second failure of market structure. So we're always looking to align our trading tactics with these facts, understanding, identifying what strategy themes in play. The market's trading here. At this point, are we in this theme? Are we going to transition? Well, we're anticipating a reversal. We're still the optimal strategy because we had the rejection. We're expecting this. We're expecting this. We're expecting an exhaustive move. And as soon as they start to fail here, and we get this breakdown, and we're getting pullbacks here, we're anticipating this to be the high point. And granted, the DAX didn't give us a lot of opportunity, but it definitely told us that it wanted to trade lower. And that's what our expectation was. Going back to the S&P, we really are always looking for textbook opportunities. They don't always happen, but when they do, they really pay out. And even in the DAX, being tenacious, you were able to stay on the right side of the market. You didn't get turned around. Same with the S&P. Here's the regular session open. Just being tenacious. Where are we at? We're potentially having an emotional spike. We get a pullback. Are we thinking it's ramping up? No, the opportunity is we're still in this theme. That's our story. We're sticking to it, and the market ends up paying out two full APMDs down to the downside pivot. For more information, please contact us at info@jsservices.com. Thank you.